joining our Moving Market Podcast monthly recap. Today I'm joined as always with David Sokolovsky, and we want to recap the volatile month of August. So David, let's talk about the volatility in August.
Yeah, Jared, I think the month of August could really be broken down into two sections. You had the first half of the month, which was a continuation of the rally that we saw, which started in June on the strength of the overall U.S. economy and improving expectations around inflation. So in the first half, you saw the S&P and the Dow both continue to climb. We're up about 4% before ultimately ending the month down 4% each. So both the Dow and the S&P. And that's a very significant swing for an equity index of those sizes to reflect those kinds of changes. I think the one other thing that we saw that's relevant for August was the sharp increase in interest rates across the board, but particularly in the 10-year, as it went from 2.6% to about 3.1%, which is not a high figure historically, but in the context of the speed with which it moved up and how perhaps not everyone expected it, really kind of drove some dislocation in the market.
And when you look at the main reason why was the speech by Chairman Powell at Jackson Hole, right? And a lot of the interest rate surge you're talking about is really getting back to levels we saw in June. And to us, it feels like the Federal Reserve gathered as a unit and really wanted a coordinated effort to talk down inflation. So every speech you hear from the Federal Reserve is pretty much the same. We are going to raise interest rates until inflation is low for a long period of time, right? And to us, it feels like they're very fearful because Powell stated a couple times of historical precedent to compare to as they're worried to ease too early to have inflation get embedded or come back. And really, I think what they're talking about is 1970s of what you saw with the whipsaw easing, and then by the late 70s, early 80s, inflation was out of control and you had to move interest rates up dramatically. And that seems to be what the Fed is most fearful of. The reality is this is not the 1970s. But nonetheless, the reaction to the markets was to finally listen to what the Fed had been saying, that they're going to keep raising rates. And that's where you saw that major negative reaction, both in the stock and bond market.
And Jared, do you anticipate the Fed's kind of reaction and some of the steps that they're taking to be surprising, or have they telegraphed this along the way?
They've been telegraphing clearly. And I think if we sort of walk through what they're really looking at, and share a graph on the CPI index. And again, what we're looking at here is the last 12 months. You can kind of see I've been talking about this a lot this year, is the Federal Reserve managing yesterday's inflation or tomorrow's, right? And they're very focused on yesterday's inflation. And, if you want to walk through the data here, David, and kind of what we're talking about here.
Yeah, so if we kind of look at this is the last 12 months that the Federal Reserve has put out. And basically the way that it works is this is the change in prices from prior month in percentages. So this is half of 1% in July of 21 versus June of 21. And so these numbers, to get to that 8.5% headline number that we've seen, these numbers are essentially compounded. So you take 0.5% increase, multiply that by a 0.3% increase, multiply that by 0.4, and so on and so forth. And so the last 12 months combined is what kind of get you to that 8.5% headline number. I think, Jared, what you're alluding to is, in July, we had very positive news on the inflation front, primarily driven by oil, but you had overall inflation month over month at 0%. So what that means is essentially whatever you were buying in July cost the same as what you were buying in June. Obviously, some things were more expensive, some things were less expensive, but overall, that continuous basket of goods that we would collectively purchase would cost the same. What drove that, I think, is, and we've seen part of that was the decline in oil prices, going from about $120 a barrel to about $90 a barrel. So, a lot of that benefit, which is then translated into gas prices, as well as other items as well. But I think the more interesting thing is looking ahead to August, when the expected rate of inflation is projected to be somewhere in the negative 0.1 to 0 range. So you're essentially expecting slightly decrease in pricing or potentially no inflation for the last 2 months, which then kind of brings up the question, Jared, you were talking about, is at what point does the Fed potentially change course? At what point do they pause maybe and slow down on the pace of interest rate increases? And do we expect that shift before the end of the year?
And if you take that in two parts, David, I think if you look between now and the end of the year, you have July and August that'll potentially be 0 and 0. And there really isn't any data to suggest there's a huge increase coming for September and beyond. So you really could have the second half of the year be back to inflation in the expected range. But it's still going to be, by the end of the year over year, 5 or even 6% because of those big tower numbers we saw in that chart. And then, so if you look at the last half of the year, and then let's fast forward to next year, the first 6 to 8 data points, it's going to be very difficult to see inflation increasing over 1% a month like you had. So the reality is, as we look next year at this time, you're probably going to have 12 data points of pretty moderate inflation or back to normal. So with that, it's really that the Fed does not want to acknowledge that first 0 that you just showed, David, and they don't probably going to acknowledge this second 0 we might see next week ahead of their meeting in 2 weeks. So it'll be interesting to see when they do pivot. But the reality is that long period of time could be from July to the end of the year. And when does the Fed acknowledge that we're kind of okay from an inflation perspective? Because let's talk about the economy. I mean, we're getting more and more data points in the economy, and let's put both the inflation and some of the economic data together here.
Yeah, I mean, from an economic perspective, the main thing to look at is the health of the consumer. And a big driver of the health of the consumer and their ability to spend is the labor market, right? So if you have a job, you have a paycheck, and you have a better opportunity to then be able to spend. The labor market remains very strong. We saw 258,000 jobs get created in July. That number was reported in August. The pace has slowed in September. That was just reported. And so you're seeing the labor market continue to be very, very strong. We saw the, unemployment rate tick up, but that's kind of a positive sign too, right? Because you're seeing people coming back to the labor force who are maybe not participating for various different reasons. And so that combined, the positive employment data, combined with the expectation for GDP growth, which is something that we follow very closely from the Atlanta Federal Reserve. And that is expected to be positive, right? So after 2 quarters of a slowdown, primarily driven by inventories, we're expecting to see kind of 2.5%, 2.6% GDP growth, which is kind of where the Fed wants us to be. And if you look at spending, what's really driving the economy, some of the spending on the kind of tangible side has improved. So we saw auto sales, continuing to improve, but really it's on the services. And so people have been spending differently, I think, for the last couple of years, buying goods, maybe this last year, and we've seen the challenges with inventories, with people not buying as much and really shifting to services. But I think we're starting to get closer to that mythical year, Jared, where we talk about where you're going to spend on one item and somebody else might spend on another, versus the whole economy focused on one particular sector.
Well, and part of what I think is you put all this together, David, it feels like the Federal Reserve might be afraid of a normalized economy, that we got there sooner than expected. Things are still okay. As you said, tracking a 2.5% GDP, it's not a huge growth number. It's not a slow number. It's kind of a very good sustainable level. And if inflation is 0 trending back to 2%, there really is, putting this together, it feels like we're kind of back in that normalized environment. It's just that the scare the markets have is they continue to react negatively along all these data points you're talking about, that the good labor market is bad because the Fed wants to slow things down. All of this data you're talking about that reasonably good turns into bad. So the issue as you look to the rest of the year ahead is, we think things are in pretty good shape and inflation is trending in the right direction. The wild card continues to be, when will the Fed acknowledge that we're kind of back to that normalized level? If we are, we agree, you need more data points to put these together, but some of this just comes down to the feel. The feel of the economy and inflation is not like it was in May and June, where everything kept going up and up and up. It's just not the same feel, and expectations continue to improve overall. So with that, looking ahead, short run, the markets are heavily computer oriented and programmed. So as we're looking for opportunities, Dave, let's talk maybe a little bit about the short term and what to look for here.
Yeah, I think through the end of the year and really at least past the next Federal Reserve meeting where there'll be a little bit more insight. But it's just, to use a baseball analogy, taking singles, right? So just reducing the overall portfolio risk and taking smaller opportunities where we see them, particularly in the income space. We continue to see yields going up, which means you don't need nearly as much of an overall portfolio to generate a significantly higher level of income throughout your retirement. I think the second thing, and more importantly, or not more importantly, but equally, is to kind of keep an eye on, like you said, the computer trading and the technical levels. Those are becoming more important because as activities exacerbated by algorithmic trading, that gives us an opportunity to follow some of those trends. And, as we see them breaking technical levels or continuing to repeat those cycles, which we've seen over the last couple months, it gives us an opportunity to, allocate a little bit more cash to the growth side. For example, as the market declines, and then take advantage of some sales as the market goes up. And then the last thing, and like I said, is really just the Fed. So getting an understanding of what they're thinking and how their thinking might be shifting coming out of this meeting in September, and then later in the year as well. So if they're starting to see these data points and acknowledge these data points, I think they're still going to continue to be cautious, and still are going to probably, anchor more to the conservative side and make sure that they don't let inflation come back. But at some point, as they look to pause interest rate hikes, that'll provide more opportunity for the market then to grow.
Yeah, and I agree. Looking at the technical levels, so as you're sitting on cash, a lot of people have extra cash. You're just being cautious from all the volatility. As you break technical levels or go back to June lows, those will be great signs to be a little more aggressive and look for those long-term opportunities in the equity markets. Meanwhile, as yields have jumped, it is not a bad time to continue to lock in yield. We've been talking about this the last few months. It's the most yield you could lock in risk reward in years and years. So it's not a bad time to do that. But be mindful that continued volatility, and as things steady, we'll see what's ahead. But with that, I want to thank you for tuning in, and we'll talk next month about what the Fed said in September.
Thanks.